Hello friends, what's up? Let us begin the new video on this particular topic, financial markets. In this particular video, we will start studying about the money market, which is the first kind of financial markets. We have seen that financial markets are of two types. One is called money markets, where there is transactions, short-term transactions, like from 1 day to 364 days, which is less than 1 year. And then there are capital markets, where the long-term transactions take place, which is more than or equal to 365 days. So we will study them one by one. For first, let us start the money market. So money markets are regulated by RBI majorly. So Reserve Bank of India is the regulator of money market. And in money market, only the debt instruments are traded, okay, and no equity. I'll explain to you the meaning of debt and equity, okay, in a very simple way. Say for example, you are a businessman, okay, this is a businessman, and this businessman wants to do some investment in his business, okay. He wants to invest, say, rupees 20,000 in his business. Now he doesn't have this 20,000 rupees with him. So what he can do is, he has two options. So say for assume that there is no bank, there is nothing. So there is this another second person who has this 20,000 rupees. Now this person has two options. So this person will say that you please give me 20,000 rupees and I will pay you back. Okay, I will pay you back, say, after 1 year, 2 year, with some interest. Okay, so I will pay you back the entire 20,000 rupees plus interest. So it is principal plus interest. I will pay you back after 1 year, 2 year, 3 years, whatever. This is one option. There is another option. This person can also tell him that you give me this 20,000 rupees and I will give you the share in my company, okay, worth rupees 20,000. So he's saying that if my total business, say for example, if my total business is, say, rupees 1 lakh, okay, the total investment in my business is 1 lakh, and I have my own 80,000, I want extra 20,000, I am taking it from you. So now you become the owner of 20% of my business. Okay, so he is giving him the ownership. He will not pay him back now. He is giving him the ownership. So if he is giving him the ownership, such kind of investment is known as equity. Okay, this is known as equity investment. This person is doing equity investment. And if the investment is of this type, where this person is lending him money and this person A will pay him back the entire amount along with some interest, such investment is known as debt investment. Okay, debt investments. So this is the debt instrument and this is the equity instrument. Okay, so you try to understand this. So in money market, there are only debt instruments and not equity investment. So it is only of this kind. Okay, there is no ownership transferred equivalent to the amount that is invested. And it is for short-term money-related transactions, okay, up to maximum 1 year. Okay, in fact, it is less than 1 year, 364 days. If it is 365 days plus, then it is it again automatically becomes a long-term investment. Now, what are the different instruments in this particular market, in money market? So it is T-bills, which is also known as treasury bills. Then WMA. WMA is nothing but ways and means advances. Okay, ways and means advances. Then commercial papers, commercial bills. Sorry, I've repeated this again. Commercial papers, certificate of deposits, discount and finance house of India limited, DFHI. So this is not a instrument per se, but it is an institution set up in India to have some liquidity in the money market. This I will explain to you. Now we'll study one by one each of these. Now treasury bills or T-bills are basically the bills which are issued or say auctioned by the Reserve Bank of India on behalf of the central government. So state government do not issue T-bills. You have to remember this. Treasury bills are issued only and only by the central government. Okay, this is very important. And on behalf of central government, who does this activity? The RBI. RBI will issue it on behalf of the central government. Okay. It is up to 1 year, maximum 1 year. This we have seen, it is 14 days, right? 14 days, 364 days, 91 days, like this. So these are the different maturity period of the T-bills. They are zero risk as they have the sovereign guarantee. Now since they are the instruments of the central government, so it is considered to be a risk-free investment. So because it has a sovereign guarantee, so government of India, the central government will never default on its payments, because government of India is a sovereign government, and therefore these instruments are considered to be zero risk instruments. Okay, so there is no risk involved in these instruments, and if the risk is low, then the returns are also obviously low, right? So you get a very less return, but it is considered to be a very safe investment. There is very high liquidity. Okay, you can buy and sell these T-bills any point of time. The liquidity is very high because the demand and supply of these T-bills is also very high. Okay, because of the short term maturity. The maturity is just short term. So for example, if you purchase T-bills of say 14 days, within 14 days you will get your money back. Okay, or you can also sell and purchase this, and it has a very high liquidity. And anybody can buy T-bills. Okay, it can be any person, it can be individuals, it can be firms, it can be trusts, it can be institutions, it can be banks, etc. Anybody can buy T-bills. And it is a zero coupon bond. Okay, it is a kind of bond only. Bills are a kind of bond instruments, meaning debt instruments only. Okay, and it is zero coupon and it is sold at discount. Now I'll explain to you what is the meaning of this. See, for that, first we need to understand the meaning of the bond. Okay, what is the meaning of a bond? Now, previously in the olden days, when there was no computer or demat systems, so a bond used to be like a paper. Okay, just like we have a piece of paper, and there used to be a coupon. So see, this portion is the coupon. Okay, so there used to be see, we have so many there are tickets where this some part is can be torn off. Okay, so some part can be torn off from here, and so this portion was known as the coupon, and on that coupon it was mentioned some value. So say for example, this is an instrument of debt, rupees 20,000, government of India, or say it can be private, it can be government also. Okay, if it is a bond, say for example it is a government bond, so government of India issued on 1st January 1998. Okay, such a bond was issued by government of India in 1998, and the value on that bond was rupees 20,000, and it was mentioned that after 1 year, so after on 1st January 1999, you produce this coupon. Okay, and you will get rupees 100 along with your 20,000 rupees. So what is this? So this 100 rupees is the interest, is the return that you're receiving on your investment of 20,000. So you multiply it by 100. So what you will get? You will basically get the interest rate that you are receiving here, right? So 100 rupees on 20,000. So it is 0.5% interest rate you are receiving on this particular bond. So this is known as a bond where the value of bond, this is known as the face value. Okay, the face value of bond is mentioned here, and this is the coupon rate. This is the coupon, the amount that you will receive as a return. Okay, so but these T-bills are zero coupon. Okay, so here on the T-bills, the return that you will get is zero. It is mentioned zero. Okay, nothing you will get as a part of coupon. But now you will question, if you will not get anything after 1 year, or say after 14 days, or after 91 days, whatever is the validity of the T-bills, if you will not receive anything, then why will you invest? So that is why the T-bills are sold at discount. Okay, they are sold at discount. Sold at discount meaning it is sold at a value less than the value face value. Okay, so for example, if this coupon was not present here, okay, if nothing was mentioned here, if it was not present here, then nobody will buy this particular bond at 20,000 rupees. They will demand it at less. So for example, they will demand it at say rupees 19,000 900. So or 19,800. So what is happening? This coupon, this bond in the market is getting sold at a discount. This is known as getting sold at a डिस्काउंट. सो ये उसकी जो फेस वैल्यू है उससे कम पे मार्केट में बिकता है, बिकॉज देर इज नो कूपन हियर, देर नथिंग इज guaranteed as a part of coupon. And if people want return, so obviously they will not pay this entire amount. Who will pay 20,000 rupees today and receive the same amount after 1 year or 2 years or 14 days or 91 days? So nobody will do that. So such zero coupon bonds are sold at discount. And similarly the T bills are also zero coupon bonds. Okay, they are zero coupon bonds. This you have to keep in mind. Now let us come to the next type of instrument, which is known as commercial bills or commercial papers. Okay, now there is a little bit difference between these two. First of all, you have to keep this in mind that commercial bills and commercial papers are issued by the private companies. Okay, they are issued by the private companies or corporates. Private companies or corporates. It can also be government company. It can also be a government corporation. But definitely not the government, definitely not the government of India or government of any state. Okay, so it is always issued by some company which is doing some business. Okay, so what is the basic difference between these two? Commercial bills are just like T bills only, but treasury bills are issued by the government of India. Commercial bills are issued by one business to another instead of the credit transaction. For example, there is one company, business one, and there is another company, business 2. So business 1 can sell its products to business 2, and in return it can get the commercial bills. Okay, commercial bills of business 2 instead of the credit transaction. Instead of getting the money, it will get its commercial bills, and later on these commercial bills can be traded in the market. And can be sold at the value that is prevailing in the market. So commercial bills are also known as trade bills or bills of exchange. Okay, so they are also known as trade bills or bills of exchange. Now there is another type of instrument, which is commercial papers. Now it is issued by a corporate whose net worth is more than 5 crore. This is important. So corporate should be more than 5 crore worth, and it is issued to the banks. Okay, it is not issued to another company. It is issued to the banks. And the maturity is up to 270 days for commercial papers. And once the bank gets it, so for example, what happens, there is a company, say business, it is now selling these commercial papers to banks. Bank is giving back the money. Now bank will receive these commercial papers, and these commercial papers the banks can sell to the investors, like individuals, other banks, other companies, or foreign institutional investors also. So the banks can trade them in the market. Okay, so these are the different businesses, these different instruments that is happening in the markets. They are a kind of promissory notes. Okay, promissory notes meaning they are unsecured debt. So it is just a piece of paper, and on that it is written that this company has taken this much money, and on production of this paper you will receive this much amount, say rupees 20,000 back along with some interest. So it is a promissory notes. Promissory notes meaning on which there is written a promise that we will return this much. Okay, it is unsecured. There is no security to it, but it is given by some very good companies, large companies, on which there is a trust of the people, of the company, of the market, okay, of the banks. So they are kind of promissory notes. And there are also asset-backed commercial papers. So these are the unsecured debt. There are also some secured commercial papers. They are known as asset-backed commercial papers. So they have some backing of some asset, some property, any asset. Okay, so they are known as asset-backed commercial papers. Now let us move on to the next one. The next one is certificate of deposit. Okay, certificate of deposit is issued by a banks against the deposits kept by individuals and institutions. So they are the same as fixed deposits, but negotiable and tradable. Now see, for example, there is a person who goes to a bank. So he has two options. He can put his money as an FD, okay, as a fixed deposits, and in fixed deposit you will receive a piece of paper which is known as the fixed deposits received, FDR. On that it will be mentioned that you have saved rupees, say 10,000 rupees for 91 days, okay, and you will receive 10,040 rupees after 91 days. So for example, this is the FD. This person will go back after 91 days and get his money back along with the interest. But there is another instrument. This person can also invest his money into bank, and instead of FD he will receive the certificate of deposit, COD. Now what is the benefit of this COD? This COD can be traded in the market. Okay, he can, for example, before 91 days, if he requires this money, so if he goes for FDR, he cannot withdraw this money before 91 days, or in case he withdraws this money, he will have to pay some penalty. But in certificate of deposit, it can be traded easily in the market, and it is negotiable. Okay, so the price can go up and down, and the banks can also negotiate. So that is known as certificate of deposit. Again, money market, very liquid. Okay, because they are short term. Now finally, let us look at the DFHI, Discount and Finance House of India. It was set up as a subsidiary of Reserve Bank of India in 1988. Okay, so it is a subsidiary of RBI. You please keep this in mind. And it is why it was established. It was established to stimulate the activity in money market, to make the money market more active. See, in market, what are the two things very much important? Supply and demand. Okay, so in some of the market, if there is no supply, if there is no demand, then the market will fail. Okay, the market will not get established. So the Discount and Finance House of India, what it does, it creates a demand and also provides the supply whenever needed. So whenever there is a slack in demand or slack in supply in the market, it will create the artificial demand or artificial supply in the market in order to keep this market running. Okay, to keep this market active. That is the role. And it is a kind of secondary markets for money markets. Okay, it is a kind of secondary market. It is not the secondary market. It is a kind of secondary market where it creates some artificial demand and artificial supply. Now let us look at the WMA, ways and means advances. So ways and means advances are taken by the state government or the central government. Both of them, they can borrow from the Reserve Bank of India to finance the temporary budget deficits. This we have already studied, when we have studied the fiscal policy. Okay, so there are some cash flow mismatch. So for example, say the government of wants to pay its salaries plus increase in DA, increase in dearness allowance during the time of Diwali to its employees, but it is going to receive the income tax or the tax in the month of March, but it wants to pay it now in the month of November. So there is a temporary mismatch in the receipt and deposits of the government of India. So at that time it will borrow from the Reserve Bank of India, and it is a kind of temporary deficit. It does not count as a part of the fiscal deficit. Okay, it is only to manage the temporary cash flow mismatch. Okay, cash flow. For example, you need the cash today, but you are going to receive the cash after 5 days. So for this 5 days, you need to make some adjustment. So there, the RBI helps the central government. And this provision is as per the section 17 subsection 5 of RBI Act. Okay, this is allowed. This is the statutory power of RBI that it can do it. And it is often issued at repo rate. Now obviously RBI, if it is giving money to the central government for a short period, say for example 1 month, 2 months, 90 days, 30 days, so it will also take some interest, okay, some returns, and that return is usually the repo rate, okay, for WMA. And it is for maximum 3 months. Okay, WMA is for maximum 3 months. This is again important, and it was first implemented in 1997. Okay, so this is about this. Now this is the last topic for money market. So there is one concept called call money or notice money. Now this is for the interbank lending. Okay, interbank lending. For example, SBI is lending to HDFC, or ICICI is lending to Kotak Mahindra, etc. Okay, it can be between the two banks. It is known as interbank lending. So these are the short-term borrowing among banks and financial institutions. It can be among banks and financial institutions. So NBFCs can also participate in this call money and notice money market. There is no collateral needed. Okay, collateral is not asked, only to fulfill the CRR requirement. Why call money and notice money is taken? It is only for fulfilling the CRR, cash reserve ratio requirement of the banks, which which is a part of regulation of RBI for the banks. If it is for 1 day, it is known as call money, and if it is for more than 1 day but maximum 14 days, it is known as notice money. Okay, again you have to remember this. If it is for 1 day, borrowing is only for 1 day, overnight borrowing, it will be called call money, and if it will be for 1 to 14 days, it will be called notice money. Now again some interest will be charged, okay, फ्री में तो कोई देगा नहीं, nobody will give the money for free. So the interest that will be charged for this will be calculated based on the MIBOR. So MIBOR is known as Mumbai Interbank Offer Rate. Okay, so Mumbai Interbank Offer Rate, see, it is because Mumbai is the financial capital of India, there is a it is defined in Mumbai. Then interbank meaning the transactions between two banks, and offer rate meaning it is offering the money. Okay, you take this money overnight. Okay, so the yardstick for call money, overnight money, is the MIBOR rate. It is the Mumbai Interbank Offer Rate. This is nothing but the interest rate that the banks charge to each other when it is giving them the call money, that is money for one day. Okay, so this is a very simple video in which I hope you have understood the different concepts of money market, okay, which are the short term financial markets. In the next video we'll continue this topic. Thank you.